We are in a bear market. The S&P is over 20% down from recent highs. Over $7 trillion has been wiped away from the stock market. This is not a fun time for long-term investors. All of our long-term accounts are obviously taking hits during this, but it doesn't have to be all doom and gloom. Out of bear markets historically forever have become great buying situations. So I want to look to today to put you all on a couple of stocks that I think are already approaching great buying opportunities and may continue to just get better buying opportunities as the market continues to dip. Obviously, not financial advice. Don't watch this video and go buy the stocks. Please do your own research. But hopefully this helps give you all some ideas about these stocks and specifically how to look at valuations of stocks when looking at buy opportunities during this market dip. So hit like, it really does help. Hit the red subscribe button if you're not already. And let's just go ahead and jump right into it. No need to dilly-dally. So the first stock I want to put you all on is a stock I have been talking about for a little while. I actually made a little bit of money on it not too long ago, but that is Best Buy. Best Buy is down nearly 50% from highs. I think it actually did touch sub 70 on Friday. So it did touch down over 50% from recent highs. Now, a very important thing when looking at stocks to buy during bear markets is not to just go, oh, it's down over 50%. It has to be a good buy. That was not at all the case. Everyone wanted to buy Shopify around 1,000 because it had dropped 70%. And everybody wanted to buy, I'm trying to think of another one. Block was another one. People wanted to buy around here just because it looked good. You've still got to look at these things valuations, right? Not just, oh boy, look how much it's dropped. But let's go ahead and do that. Let's look at its valuation. So obviously we are on Yahoo Finance. If you search a stock on Yahoo Finance and then click the statistics tab, obviously you'll be able to see all the same information that I am seeing now. So let's look at Best Buy's BBY Bravo Bravo Yankee. Let's look at this ticker's valuation. So they've got a 17 bill market cap and they've got quarterly revenues of 51.76 billion. Their quarterly revenues is nearly 4 times their market cap, which is wild, right? They're trading at a great valuation there. Their forward PE at 8.4 is quite low. Now you would need to compare that against retail. Like you need to compare their PE and PEG ratios against retail. I have done that. It's pretty comparable, especially for a company as big as Best Buy. But at 8.4 forward PE and a 1.08 PEG ratio, meaning they're trading right at about what their expected 5-year growth is by analysts, which is also good. You know, a PEG ratio of 1 is great. Obviously, anything under 1 is also great as far as value goes to buy during this dip, right? Now, we also, so their numbers look great. Their valuations look pretty good. Now, also, when considering what stocks to buy during bear markets, you need to look at their books. You need to buy companies that have survivability, right? We're not in a recession yet, but bear markets are oftentimes leading indicators to recessions. And if we do end up entering a recession here, if the American economy ends up going into an official recession, you will need to find companies that are able to survive them. So we're going to come down and look at their books as well. They do have just about $3.94 billion in debt, but they have $2.94 billion in cash. So they're close. They're not far behind on their cash to debt, which is good. And their EBITDA, their quarterly EBITDA, and EBITDA is the money that's brought in after they've paid everything. Think of it as the money that you get to keep in your savings account after taxes, after groceries, after your gas you have to spend. Think of that as EBITDA. So they're bringing in the same amount of money as their debt, and they just about have as much cash on hand as their debt. So maybe not super high survivability. Maybe you want to see a little bit more cash than debt, but they're right up there. They're going to be able to stick around for a while. It's not like they are going to have to default on loans and stuff at their current book value, their current book ratios as well. So Best Buy is the first stock I really like as a dip buy to begin averaging into. Once again, not financial advice. Don't go buy these stocks just because I'm telling you to, of course. But my strategy with these kind of plays in bear markets is to dollar cost average in, right? I would not go take a full position right now in any of these stocks that I want to buy. Any stock that I want to buy, I am not jumping into full positions right now, because when you're in bear markets, you don't know when the bottom is. Nobody knows when the bottom is, as much as people will tell you they do. Nobody knows until it's already hard bounced, right? So just, that's a safe way to play it. It's a dollar cost average into these stocks. Something else. Now, the next one I want to bring up is Qualcomm. This stock has dropped, this ticker has dropped from 193.5 to 131. So not quite as much as Best Buy. But let's go ahead and look at Qualcomm's numbers. Their valuation, right? They've got a market cap of 146 billion. They've got quarterly revenues of 39 billion. So nowhere near as great. I mean, Best Buy's revenue was 4x their market cap. But Best Buy is also brick and mortar retail, right? Whereas Qualcomm is big tech. So it's another thing you've got to kind of think about these ratios in terms of their sector, right? For big tech like Qualcomm is, having a 40 bill revenue into a 140 bill market cap is not bad. It's pretty good, right? Their forward PE, once again, for big tech, sitting at just under 11 is also very good. And their PEG ratio at 0.64. They're trading nearly half of their expected value over the next 5 years, according to analysts, which is very, very low, once again, especially for big tech that is traditionally traded at more growth valuations rather than value stocks, right? So when you start to see big tech like this coming below 1 PEG ratios, they, once again, historically have been great purchases, right? So there's your valuations. Now, let's look at their books. Can they survive a recession? Their total debt, $15.68 billion. Their total cash, $11.5 billion. So not quite as one-to-one as Best Buy was, but they're still right there, right? They're not going to be defaulting on debt. And look at their EBITDA. Once again, the amount of money they bring in after all their payments is $14.5 billion, which is right there in line with their debt. So they can afford to make their debt payments, and they've got plenty of cash on the back end. If this EBITDA, that's the point. If we go into recession, this EBITDA is going to start getting smaller. Are they going to start defaulting on loans? I don't think so. I think Qualcomm's books are in a pretty good place. So Qualcomm being the second stock that I like to buy. Third and final stock that I think is a great purchase right now, and once again, if the markets continue to dip, we'll continue to get even better and better ideas for being purchased potentially. But that is Google, or Alphabet, shall I say. Google's parent company has dropped from over $3,000 a share to sub $2,200 a share. They also have a reverse split coming up. I believe it's 4-1, or is it 6-1? Someone in the comments correct me. I believe it's either 4-1 or 6-1, or maybe it's neither. But they do have a stock split coming up in the future as well, so they will get more affordable for retail, which tends to, once again, historically tends to lead to, you tend to see strong performances of stocks after they do their stock split. So that's something else that's coming up, I think, relatively soon as well. I believe it's like early July. Or maybe it's even early June. I should know more about this. Look it up yourself, I guess. There is a stock split coming on Google. Let's go ahead and look at their valuation, though. So Google, click on statistics. Google is once again, obviously a mega tech company, so you expect to see a little bit higher valuation type trends than you saw on Best Buy. But let's go ahead and look. Market cap, 1.48 trillion. Obviously, it's Google. They're a massive company, one of the biggest companies in the stock market. It does not mean, once again, I think a lot of people are scared of that. They don't want to go touch the biggest companies in the stock market because they feel like they have the most to lose or whatever, right? But if their value is there, their value is there. So let's look. Off their 1.48 trillion, they have a 270 billion revenue. That's less than 1/5. That's actually the worst revenue to market cap we've looked at of these three stocks so far. But once again, Google is a massive company. It's going to trade. It just is going to trade at higher variables, right? Because it's such a big, powerful company, and we're going to get into their books here in a second as well. But what I really, really, really love about Google, this PEG ratio. I think this might be my favorite thing about Google, and then we're going to get into its books too. But PEG ratio, for a company that's the size of Google to be trading not only under 1, but under 0.8 5-year expected growth according to analysts for such a huge continuous growth company is insane. It's hardly ever heard of, and it's almost, once again, historically, it's been a very, very good time to buy these huge mega tech type companies when they do drop below these levels. Let's go ahead and jump into their book. So they've got $28 billion in debt. They've got $134 billion in cash. I don't even know if I can do that math quick enough in my head. Is that nearly 6x? A little bit less than 6x their debt they have in cash, and their EBITDA is $96 billion. They're bringing in nearly 4x the amount of money they're coming in every quarter as their debt. They're very, very, very recession proof. I mean, Google is ready to make acquisitions. They're not just recession proof. If the market continues to get hammered and stocks, other companies' valuations obviously come down, Google is right there right now to be ready to start acquiring some of those companies as they come down for future growth. They're not just poised to survive any kind of large recession. They're poised to be the ones able to take advantage of other market caps coming down via acquisitions. That's why I really like Google. And it's also another idea, said we're going to get to it. It's another reason why the revenue to market cap is maybe so low on Google, because if you have books that strong, the stock market has to put the value somewhere, right? So it makes the market cap to revenue look a little bit worse. But because of that PEG ratio, because, on a mega tech, this PEG ratio and the strength of these books, that is why I think Google is also your third really good buy now during this bear market. And once again, they'll continue to get better if the markets continue to dip, because all three of them, I do believe, are recession proof. But that's the video. Those are the three stocks. Once again, Best Buy, Bravo, Bravo, Yankee, Qualcomm, Charlie, Oscar, Mike. Quebec, Charlie, Oscar, Mike, and then Google are the three stocks that I am looking to start dollar cost averaging into, and the ideas that I wanted to put out there for you all as well. So hopefully you all enjoyed the video, and once again, not just for the fact that, I like those three stocks too now, but you also got to see how I can quickly look at the valuations in stocks and start to determine what is a good buy and what isn't a good buy. Once again, not just because the price dropped, but because the valuation also lines up, right? Because price dropping can still drop. So we've looked at the valuations of these three companies, and we've really come to a conclusion. So hopefully you guys enjoyed the video. If you did, could you please take the half second, hit the like button, and if you're new around here, I post free stock trading videos every single day on this channel. So why not hit the red subscribe button? It's free. With that being said, I'm going to go ahead and sign out of this video. I will catch you all in the next one.